Hi guys, thank you for watching all my videos. The views are going up and I'm really thankful to you for sparing your valuable time to watch those videos. In this video, I talk about my professional journey as an investment manager. I got placed as a wealth manager in the year 2004 immediately after my MBA, and in the last 18 years, I've learned a lot of investment management principles either through experience or by understanding various investment managers or from legendary investors. In this video, I talk about 5 such principles which can make all of us a better investor. I'm sure you also want to be a better investor. So please watch the video till the end. Tell me if I'm wrong. We've all seen investment managers wearing nice ties, nice coat, walking with a lot of confidence, talking a lot of complex things so that they sound or look more impressive, more savvy. But to be honest, it is a lot more difficult to be simple than complex. Keep it very simple. This is the investment mantra that you should follow. Your investment strategy should be simple, consistent, and should produce results in the longer term. If you're convinced about it and understand the strategies in ins and outs, you will stick to it during its great period and also during its bad period. And in general, if the strategy is good, it will yield results in the longer run. Therefore, my only request is please keep your investing strategy very simple. Don't make it complex at all. The second principle, which I've actually borrowed from Mr. Howard Marks, the legendary investment manager, is assets always move in cycles. You take any asset, take your real estate, your debt, your equity, your currency, your commodities, and you will see that they always move in cycle. Interest rates about 3 years back were at 9% and today it is at about 5%. Equity, as you know, was down in the dumps in 2020 and today it is almost near all-time highs. Same applies to real estate or currency or commodity. Why is this important? Let me give you an example. We always pay a price for the future growth. And when the cycle is at a peak, we may end up paying a huge price for the growth that may or may not happen. Therefore, one of the roles of a good investor is to understand where are we at the cycle and what kind of risk we need to go through to earn the same kind of return that we've earned in the past. If you end up paying a huge price, then the growth will not happen in your portfolio. And on the other side, if you're paid an excellent price for the future earnings, you would make tremendous amount of growth in your portfolio. So always remember, assets move in cycle. You always need to assess where exactly are you in the cycle. Talking about earnings, one principle which is very clearly mentioned by many legendary investment managers, which I have personally seen in my lifetime of investing, is that earnings is always followed by growth. Stock prices are slaves of earnings. If the company or the asset that you're investing in is showing real growth, I'm not talking about fudged earnings growth, I'm talking about real earnings growth. If they are showing real earnings growth, without a doubt, the price will also go up. You can take any example for that matter. In fact, the growth rate of the price of an asset is very close to or maybe a little higher or lower than the earnings growth. So please remember, earnings growth is going to be followed by price growth. Talking about price, please remember, you shouldn't end up paying a huge price for the future growth. As I said earlier, all the assets go through cycle. So when you are at the peak of the cycle, for all you know, you may end up assuming a significant amount of growth in the future, for which your model will say, let's pay a good, nice, high price. But please remember, future growth is very difficult to predict. And if you're predicting some 10 years of growth and you've already paid the price for it, then how are you going to see the price growth? Therefore, remember, earnings growth is important. Also remember that the price that you're paying should be very close to the expected growth rate, or even more better if you get a great deal and you end up paying the price which is lower than the intrinsic value of the particular asset itself. Hope you got my point. Is this the right time to invest in the market? This is something that I have been asked maybe 100 times in a year. I am sure everybody has this question before giving their hard-earned money into equity, because equity in general in the short term is risky. What I've seen in the past is that there is nothing called efficient market. Experts always say that the price already reflects the future growth, which I don't think is correct. I always believe that there is an opportunity in the market always to invest, whether it is in a great bull market or in a bad bear market. You will always find opportunities to invest, and therefore don't try to time the market. Don't try to wait for a big correction. Of course, if the cycle is almost near the top, try to stagger your investment, and if the cycle is at rock bottom or somewhere in the middle, just go lump sum. Just don't try to time the market saying I will wait it out. I will wait till it corrects 10-15%. Remember, even after correcting 10-15%, the market can correct another 10-15%. So when you invest in good companies which is showing great earnings potential, you don't really need to worry too much about timing the market. It's all about finding good opportunities, paying decent price for the future earnings growth that you're going to see from that particular asset, and keeping this strategy consistent. Keeping this strategy as your only mantra. And this should definitely help you make a better investor. Do you think there are a couple more points that you can add to this investing strategy? Please let me know in the comment section. As always, happy investing.